There is a sense that the world is moving very quickly and markets very much are in focus. And I want to start by getting an overview of how you're seeing things right now. SpaceX IPO, you are the only Canadian bank to play a part in the distribution of that. How would you describe the state of markets that we're seeing right now?
Well, I think there's a real appetite to take risk. We see that in Canada. You see that in the United States. It's absolutely risk on. Right now, there's a hunger for new issues, as you saw with SpaceX. There's a real focus on technology, without a doubt. But even look at Canada, when we talk about building new pipelines, we talk about building rare earth mineral capability, we talk about exporting more food, the capital flow is very interesting and strong. In fact, we're going to have an investor day for Canada in September that I'm sure we'll talk about. So when you look at the risk-on environment, we're certainly feeling that in our own stock and greatest foreign interest we've seen in the ROI stock in quite some time. So there's a hunger for traditional businesses, but then to your point, these emerging technologies in space and satellites, absolutely, the push for AI and capacity, compute capacity, memory capacity is driving a insatiable appetite for all forms of capital, debt and equity.
It's insatiable both on the part of the companies looking to borrow as well as the investors looking to get in. It feels like there's this race. Why? Why is everyone so eager at this moment? Why is it important to just hoover up as much cash as you possibly can and lend your money out as much as you can?
Well, we're being careful. We're not just throwing it out there, but we're certainly within our credit standards. Well, there's a couple things happening. One, there is a race among the hyperscalers and among certainly the compute and memory providers to capture this demand, right? So there's a race to serve clients. There's all these hyperscalers and frontier models have demand for their product. There's a shortage currently. We don't know what the long-term demand cycle is in supply. But certainly there's a shortage of supply against demand. So there's the race to capture that and who can get these things built. And this energy supply is critical. There's a not in my backyard and NIMBYism creeping up. So there is a race to capture this demand and scale. It's a scale bet. So I think that's driving demand for capital. There's also on the other side a fear of will there be enough capital for all demand out there. It's driving a huge amount of not only debt, bank-to-bank debt and syndicated bank debt, but certainly high yield issuance and then equity issuance. So we're using the full capital stack already to satiate this short-term demand. So it's both a fear of capital. Are we running out? No, but I think you're certainly seeing in a syndicated bank market, it's not infinite. And you see bank balance sheets filling up really quickly. And it's not an unlimited amount. If you're prudent about limiting your sector approach, you have to kind of watch your balance sheet as well. So I think you're seeing high yield issuance and you're also seeing equity issuance on all this side. So it is a very significant growth engine for the economy and for bank balance sheets.
As a bank, are you taking more risk right now or paring it back because balance sheets are filling up?
It's a great question. I think depending on the economy you're in, we're certainly taking more risk in the United States right now because the economy is performing strongly and there's demand, particularly out of the tech sector. In Canada, I think demand is a little more muted in a number of areas because we haven't resolved USMCA. I think the confidence in investing in the long term is a little slower right now. We're certainly seeing some demand come out of the Canadian economy, but I would say it's slowing. So it depends on the sector and the market. But demand out of the U.S., and where we're seeing most of our balance sheet growth is in the United States right now.
Well, you've been expanding in the U.S. You've seen this pretty considerably over the past number of years. Are you continuing to expand in the U.S. at a time where the relationship between the U.S. and Canada is increasingly fraught?
I think the relationship, which goes back, hundreds of years, is actually strong because it's embedded in, $1.3 trillion of trade that go back and forth every year between the two countries in gross trade, $750 billion roughly each way. So that trade is largely balanced between the two countries. And so the foundation of USMCA is really, really strong. But economies evolve. U.S. economies evolve. The Canadian economies evolve. And sometimes you get out of alignment. So we're going through a public-private process of negotiating those changes. And I think that is a normal process. And I think we're making progress in recognizing what the administration needs in a change in the United States and what Canada needs as a change. And I'm confident, we'll find that agreement over time. But it is a protracted process. There's been no mention of canceling the agreement. There's a big difference between termination and cancellation. Termination just means that we're not extending for 6 years from 2036. Cancellation means you're giving notice of a permanent withdrawal. This agreement is too important to the United States and to Canada and to Mexico, I believe, to cancel. So because of that trade, 35 states in the United States, Canada's our #1 export partner. So we have a significant shock, an inflationary shock. So that's why we're discussing more the termination of the extension option, but not the cancellation of the deal. And we're trying to find a way to bring everything together with the changes in our economy.
Do you see Canadian companies trying to expand their operations outside of the U.S.-Canadian borders? In other words, maybe looking more to Europe, looking more to even Asia to try to get a little bit more diversity?
Absolutely. It's a big part of our Prime Minister's strategy to diversify. Canada has 80% of its trade with the United States. If I sat down with a customer and said, you have 80% of your sales with one customer, don't you think you should diversify a little bit to de-risk that? And that's what Canada has. This is an and. We want to maintain our $1.3 trillion relationship with the United States and grow that. At the same time, why wouldn't you want to grow your relationship? We want to export another 1 million to 2 million barrels of oil a year. We want to export another 100% increase in our LNG and our 1 billion cubic feet a year up to, I think, 100 billion cubic feet. We want to export more rare earth minerals. We can be a protein superpower. We think we can we've doubled our current capacity to grow food, particularly canola and wheat, and we think we can export more of that. We need more infrastructure to do it. So Canada is looking for more partners and wants to expand and diversify its economy. So it's an and I think that creates prosperity. That creates a greater ability to pay our own way. And the U.S. has been very clear, particularly on defense. You've got to pay your own way. They're right. And we've increased our spend up over 2% now. Stronger Canada makes a stronger North America. So it's an and I think it's created an unprecedented opportunity for the next decade for Canada.
Are you expanding as well in places like Europe and China?
We are in China, not so much. Our expansion, United States first, into Europe second. We're certainly growing with a large wealth and a large capital markets operation in Europe. We're expanding into the continent to a greater degree with bigger office in Paris. And then we're looking at the Middle East, as you heard, and Asia. So part of serving the needs of Canadian exporters and U.S. exporters to have a greater global network. So it's about global transaction banking, about FX capabilities, it's about trade finance and lending capabilities. It's being present in those markets as well. So yes, we have very much more of a global mindset. HSBC acquisition in Canada brought that to us a little bit, and they showed us how to serve that client in a very different way. So we learned a lot by bringing HSBC Canada into RBC, and the number of true global clients that came with that was super exciting. So it's created a greater ambition for us alongside our national ambition to serve a more global client base.
I love that Canada could be a protein superpower. So you're going to drive the sort of fitness energy around the world that much more. You're going to try to really get that going. Maybe get Ryan Reynolds to participate in that. Anyway, one thing that you talked about is taking equity investments in Canadian companies. And that's important to you. It seems like this is actually a popular thing to do. The idea, JP Morgan's done this in terms of taking equity stakes in certain companies that are crucial to the infrastructure. What types of companies are you investing in, and why now?
I'll start with the second part of the question. We have great seed capital in this country. It comes in all forms. We have great universities. We have a lot of ideas. Those ideas are percolating up and getting executed on, but we don't have great scaling capital. We have a challenge, as is many countries in Europe, including the UK. The US scales really, really well, given its market size, the amount of risk capital you have there. 70% of the scaling capital in Canada, growth capital, came out of the United States. We've seen a diminishment of that. We needed more Canadian growth capital, and therefore RBC stepped into that gap to say, we have to put more equity into these companies so they can scale here. So they scale, and if they don't get that scaling capital for Canada, invariably they move their IP to the US or they sell globally. We need them to scale into larger companies and create that flywheel effect that you've seen with Shopify and BlackBerry and OpenText and so many others. So that's the why. We're short on scaling capital and growth capital, so we need that. And so the types of companies that we're looking at, we made an investment in Quantum to start, in Photonics in Vancouver, who has an incredible capability and they're doing exceptionally well and competing for the next major launch of that machine capability. We made an investment in a healthcare provider that serves North America in a very scaled digital technology place. So they all have a technology angle to them. We're looking seriously at our next investment in a protein supplier, lentil-based protein, with an innovative tech story on how to extract that protein out of lentils with offtake to Asia. So again, trying to follow those themes with a tech angle, an innovation angle, a growth angle, agriculture, tech, space, compute. That's what we're trying to push.
You kept mentioning tech, so I think we should get into how you're deploying technology throughout RBC, the AI tools that you've used. And can you just start with how it's changed your day personally?
Well, great question. I've actually sat down and put some thought into it over the last year, and I designed and asked the team to implement, to see if they could, an agentic CEO office. So I designed a suite of agentic tools that I thought would empower me to be more insightful about what's going on externally and internally, have a 24/7 on capability to it. I could always interact with the model and get an answer, and then allow me to be more efficient with my team instead of sending an email at night, asking them to produce a report, getting that report a week later, digesting it, calling them about the answer. I get that report in about 4 seconds today, because it's built on our data and on, obviously, an LLM, searching the entire universe of information. The components of that, I've got a macro model where I can interact on what's going on in the macro economy, look at our forecast, look at other banks' forecasts, look at what the global economy is doing, the Canadian economy. I can interact and drill that down to any element I want, compare it to our own internal data. I've got a markets model where I can talk about what FX is doing, what are treasury yields doing, what are the drivers, what are people saying, what are our traders saying, what are our positions, all that type of things. So I got a markets model. I got a consumer behavior model where I can look at credit card trends, I can look at regional credit card trends, I can look at default rates. What are people buying? Where are they shopping? What types of services? Is it goods? Is it travel? And how's that changing? How's that growing? How's that link into the economy? I look at the mortgage business. What mortgage terms? What pre-sales are we doing? Or are we in pre-sale mode? Are we going term? Are we going variable? What are default rates? And I can look at all that so I can get a feel for how the consumer's behaving, and I can link that back into what the economy's doing. So it's all really important. I've got a risk module, and I'm building an HR module to look at talent. So I have that 24/7 on, based on all our internal data, an incredible amount of internal data and external data, and it gives me this unique view on understanding external and internal at the same time.
How much time do you spend in the morning?
I start every morning with it.
So how long?
How long? Depends on my schedule of my morning, but I get lost in it a little bit, and I backlog all my emails. I would spend at least an hour on it in the morning.
Okay.
The first thing I do, I sit down, it produces a report for me, what it thinks I should know as a CEO, what I've been looking at historically and things I'm tracking. Then I either listen to that or I disregard it, and I go into things that I need to know.
Okay, so Dave's staff is in the room. Plug your ears.
Yeah.
Do you need the same number of people? Do you need the same team around you if you can do this all yourself?
It shortens the cycle, but I still invariably call my team and say, hey, the model told me this, and it seems intuitively right. Does that seem intuitively right to you at the end of the day? And then more importantly, what should we do about it? Because if it's just information and we're not doing anything, then I'm not creating real value at the end of the day. So for me, the model adds value and it leads me to ask, what should we be doing differently? So it shortens the conversation. So I think absolutely you need the team, but it increases the capacity of what we can handle and condenses the speed. Now, I was talking to a client yesterday in the tech industry, and we talked about coding. And he said, what I used to take 8 employees 2 months to do takes 2 employees 4 hours to do. 8 employees, 2 months takes 2 employees 8 hours. And he said, what I've done is I've massively expanded the capacity of the group and the ambition of the group to do more. So I think, honestly, where we are now is we're just massively expanding the capacity of the organization to to move and to create more capability and content and serve more customers. We serve 17 million customers. Our ambition is to serve 25 million customers. I mean, most of the deployment of our AI models now are not cost takeout in the back office. They are revenue enablement models, adding more customers, making our front line more efficient and more effective. That's where we put our focus, because we want to grab another 8 to 10 million customers through this. That's where we're focusing.
How does that change the composition of the bank staff?
Yeah. You're going to have more producers, customer focused, and you'll shift from the back office to the front office for sure. And that the machine will be able to start from adjudication and move back to fulfillment and close your service contracts with customers more efficiently. And therefore, you'll be able to serve more customers per employee and have more customers in the franchise. So certainly there's a shift. And I think the way I'm seeing individuals learn the business more quickly, it is unbelievable how fast these models are training our staff about banking. Because not only they're providing information, it's learning. Instead of searching around for information and taking all this time, it's right in front of you. If it's right, you learn. You learn. So you're getting on these learning flywheels. And I've seen young people come into the bank, they're learning our business so quickly. So we want to make sure everybody in the organization gets on that learning curve. I think as a society, we're going to learn so quickly. And my hope is we master these models at the end of the day, because they're going to make us smarter too. A lot smarter.
Do you think that there are a few people needed though, overall? I mean, if RBC, let's say, gains market share and can do more with the same number of people, arguably it's taking from another maybe smaller bank that would be doing the same type of thing. I just wonder from your hiring and kind of what you're seeing, if that's kind of the path forward.
I think we have to, because we have an aging demographic. And we have so many boomers. There's 30 million Americans are going to retire over the next 5 years. Just under 2 million Canadians are going to retire in my generation. And we don't have enough trained people to replace them. Like in healthcare, education, engineers, everything that we have to do, bankers, we don't have enough people. Therefore, we're going to need to be more efficient, is my view. So our view is that we'll be more efficient, we'll maybe need less people, but a lot of that's coming through attrition and through demographic change. We need that in our society. We need these tools.
We've seen a number of companies, Uber most notably recently, pull back on the number of tokens it was allowing some of its staff to work with, just because it's expensive. And, you know, it turns out humans need water and they need energy, and so too do the tokens that do some of the work. I mean, have you experienced the same type of pressures or limited the token use of your staff?
That's a great question. So one of the unique capabilities that we built, and we had the foresight to build, is we worked with NVIDIA and Jensen Huang, and we built our own tech stack. So not only do we have our own data center and obviously our own data, and we use on-prem, our own cloud, we built our own GPU tech stack with NVIDIA. So I have my own compute power. I don't have to rent that compute power from a hyperscaler. And on top of that GPU tech stack, we built our own frontier LLMs called Atom. Because we've had 100 PhDs in our Borealis Institute for RBC for over a decade now. So we've been working with machine learning, reinforcement learning, then we started experimenting with LLMs. So, you know, when OpenAI ChatGPT came out, we were experimenting with that type of capability. We weren't building it for the same purpose, but so we have our own. So that tech stack allows us to have our own token. So when we're experimenting and we're learning, we're using these LLMs internally, a lot of it, not all of it, because we still do, you know, some rental of tokens from Anthropic and from OpenAI and Cohere. But most of it is coming from our own capability, which keeps the cost to a fixed cost, not a variable cost, and allows us to do more than others. So I think that's a huge advantage for us with that tech stack.
Do you see AI right now as being more inflationary or more deflationary in the long term?
You know, the cost to build is certainly part of the growth curve in the economy, and it's driving the economy. So I think when you go back to how, you know, the personal computer came in, it was inflationary to start. You didn't see the productivity. Then it took about 6 to 7 years for the productivity to really hit 20, 30 years ago. I think we're in a similar curve. There's a cost of tokens. There's a cost of this infrastructure. We're learning how to deploy these models into our business processes, into our sales processes. The models are performing well. Like, we like the models. They have veracity. They're accurate enough to deploy. Therefore, we're just training our employees how to use them right now. So the productivity lift will start to come. So I think this, at the end of the day, will be deflationary. It'll create so much productivity capability inside your organization, inside our economy. But the curve we've seen, it starts inflationary, goes to deflationary.
This is a conundrum for a lot of people seeing the risk appetite right now in markets. Yep. Because when it becomes deflationary, there won't be as much money for certain companies maybe that are able to charge whatever they want at a time for a race. And it's starting to lead to some concerns about valuation models and whether things are getting a little bit over their skis. How worried are you?
There is going to be change to different models. You've seen this, the SaaS questions coming up. Will you, continue to rent SaaS models from third-party providers, or will you be able to code them? I think it's a bit of both. There's certainly capabilities that we will code internally ourselves that we've outsourced to third-party vendors before, and we have a list of them, and we're working through them right now. And that creates cost savings for us to invest in other parts of the organization. So I think, from that perspective, at the end of the day, there's going to be new business models coming that we just can't foresee, that people sit down with this tool and say, I can create value by doing this for you. I think we're also seeing that we're getting a lot more efficient in running these queries. So we've let our employees, and even if you don't have your own tokens like we do and you're buying tokens, there are a lot of routines and a lot of providers out there that are trying to sell you solutions to be a much more efficient searcher and to use tokens more efficiently. A simple thing is, if your employees are asking the same question 1,000 times a day, then why don't you just cache and store the answer and give them the same answer? You don't have to do research and consume a token. So there's an efficiency play that we're just learning how to do. So there's going to be an efficiency curve against this that get applied as well. So I do see significant change coming in the world of software and how software is produced and how software is consumed. And I think the market is right to be concerned about that, but it'll take time. It'll take time because we're playing offense, and then we're playing defense as well. And I think the defense is consuming time in addition.
Where are we in the default cycle, given that some of the companies that are most subject to disruption are starting to see the effects, but they still are cash flow positive? I'm thinking of whether it's software as a service, the SaaScopolis, as some people are calling it, whether it's producers in Hollywood, whether it's some of these other things that could potentially be disintermediated. How far along are we in that?
When you look at most software providers, I don't think it's a default issue because they have low cost of production, right? For them, it's probably a valuation issue to say your valuation is based on this cash flow at this price point. And when you're sitting down with a customer like us, and we have the option to reprogram you with Anthropic code or something like that, that price negotiation goes a bit differently today. Therefore, the revenue model's more at risk. But there's so much margin in those products that I don't think it creates a default cycle necessarily, but a valuation challenge, which the market has appreciated already. Absolutely.
Going forward, how would you sort of characterize where we are in the business cycle, both in Canada as well as in the U.S., which are two very different ones, partly because the 2 consecutive quarters of negative growth in Canada, a lot of it having to do with some of the new tariffs and other U.S.-Canada trade tensions?
Yeah, 2 very different markets. The U.S. is going to see it print a very large number, I think, for its Q2 growth, driven by significant government spend with a 7% structural deficit, and then obviously the hyperscaler investments, and generally a pretty resilient and strong consumer in the United States as well, growing at over 2%. So, a lot of the engines in the United States are working well. In Canada, we're number one impacted. I would say you're going to see a positive print coming out in the next quarter. We saw us exit that first quarter with much stronger performance, and that's why there's a lot of dispute. It's a technical recession, but we don't really believe we're in a recession. We think there's going to be a 1+% positive print. Job numbers are very strong, 2 consecutive months of very strong job creation, working. The consumer's resilient in spending in Canada as well. So we're starting to see the shoots of the residential mortgage market come back, which is a big part of the Canadian economy. So we're feeling generally good about the momentum we have exiting Q1, even though we had a technical print there. The second thing driving the Canadian economy right now is the lack of immigration. We have a shrinking population, and therefore that was a big part of our growth story for the last 5 to 10 years. So that will resume its growth over time. But right now you look at the year-over-year numbers are down, and GDP per capita is up quite significantly because we have a shrinking population. Each consumer is consuming a little bit more than they did before. We just have less consumers than we had. Those are the drivers of that. So I would say we're coming out of that with the superchargers of $80 billion of defense spend coming, the economy, construction of at least, I think, 2 pipelines, investment in the infrastructure, in the ports and the rail system to get that grain and get that product to the Vancouver port, infrastructure into the rare earth minerals. All these catalysts are still coming into the Canadian economy, and I think that's why you're seeing risk on Canada right now, and big time.
How much do you see this as a moment for big banks that's almost revenge of the big guys coming back in to take over where private capital left off after they were unable to raise all the money that all of these big companies needed to? And suddenly you have to help out and come in and, frankly, take market share.
And just using our balance sheet to support. No, it's certainly, we never exited that market. We've seen strong growth. We're just seeing accelerated growth in the United States because of the absence of that. And that demand is definitely there. That's good for our business, good for our shareholders. We like the risk. The margins are good. And you look at the funding levels, it's really tight, particularly investment grade, but even in non-investment grades, markets are pretty well priced. So I think it's efficient to raise money right now, and you're seeing a number of companies jump in because of the curves are really supportive of that right now, and there's worry about the backup of inflation potentially later on that could cause higher costs. You're seeing strong demand on the DCM side as well, but we've got a big balance sheet, right? We've got a strong base. We're one of the largest banks in the world, and we're looking for more customers at the end of the day. And those growth markets, as we talked about, are global, not just in Canada.
What's the pipeline like?
Pipeline's really strong. As we talked about in our earnings call a few weeks ago, strong in the tech business, strong in the United States, strong in Canada in the energy sector. As you look at these deals coming through, we are busy. Like, the team is busy. You see that in the weekly meetings and our commitments committee on the balance sheet. You see that in our underwriting meetings. We are really, really busy, and we're hiring. As you saw, we're hiring more bankers in the United States. We're hiring more bankers in Canada. It's great. It's great to be busy, and I think that's, again, a foreshadowing of there's growth coming. There's another leg of growth coming.
How much is it partly also driven by energy security issues around the conflict in the Middle East, the situation with the Strait of Hormuz? Even if there is a deal, there is a feeling that maybe oil prices remain at a higher level going forward. How much is that underpinning some of that strength?
There absolutely is a diversification strategy. Canada, I wish we got ahead of that curve a decade ago. We're a bit late, but we're certainly looking at capturing that offtake. You look at Saudi Arabia building new pipelines. UAE needs to build a pipeline. So there's obviously a strategy of decreased reliance on the straits. So this can't happen again. So that infrastructure plays in place. Reliance on partners like Canada, for sure. We have a chance to export another 2 million barrels a day. We produce roughly 5 million barrels a day. It's a pretty significant increase. There's demand for that offtake on both the LNG side and on the oil side. And we're looking to provide that capital and support that capital. They're well under their way. You're probably going to see an announcement over the next couple of weeks.
All right. I want to finish up before we open it up to questions and answers about what advice you would give someone entering the finance world today, given everything that we just talked about, given the very robust financing cycle, given the AI technological changes, given the fact that trees don't grow to the sky. What would you say?
To a young person coming into the business now, I say the same thing to all young people. One pathway to success at a big company, or even a small company, is creating a learning flywheel. Like, you have to learn fast. And I think there's an opportunity. You have to come in and lever these tools, because if you don't, your learning flywheel is going to be a lot slower. But if you master these tools in school and come into the organization knowing how to leverage an LLM or a small language model and accelerate your learning, you're going to be able to take on more responsibility so much more quickly in the organization, because you're going to have a deeper understanding of finance. So I'm pretty excited for the next generation, because I think their learning curves and their career curves can go like this. And again, we're going to need that, because we have so many boomers with so much experience retiring. We're going to need to move young people through the organization much more quickly than we did before. And you're going to contribute. I mean, I got frustrated when I started in the 80s. I'm like, but date myself. But it took 10, 15 years before I think I made a decision that really mattered. I think you're going to do that in years now. And I think these tools will provide that opportunity for you. So I'm super excited for the next generation. I know it's been hard to start, and we're in this low hire, low fire world. But once you get going, I think the path is going to be very different than previous generations, the last 100 years.
So you haven't stopped hiring or limited the number of people you've hired?
No, we've actually hired more students this year than we ever hired before because we need that talent, that capability to come into the organization because of the demographic gaps. But I think we're up over 5% increase. So we hired over 3,600 students this year. And it's a lot more than we normally hire because we need that skill set to come in, and we need to create that opportunity for young people in the United States and in Canada across all our network. So it's this summer we accelerated that.